Good morning, Dr. Chang. Let me say in beginning, I want to thank the Korean Economic Daily and the Global HR Forum for inviting me in the United States, of course, this evening. Let me start by taking just a few minutes to review the American scene because it's undergoing remarkable changes which are hidden under the surface of essentially what's going on the surface. We are at the moment, in recent weeks, exhibiting a degree of weakness, especially in manufacturing. This is through August to September, and in the first 3 weeks of October. The weakness is essentially a consequence of very substantial increases in inventories of manufactured products in July and August. And since then, the rate of accumulation has been coming down, and that, of course, is bringing the level of economic activity down with it. But the level of inventories is not very high. So while the rate of change is coming down, the level is not likely to be pushed down very much, if at all. And as a consequence of that, I would see the economy beginning to flatten out going into the new year, and probably, as far as the United States is concerned, is accelerating somewhat. However, this country and others around the world, most prominently the United Kingdom, is undergoing an extraordinary, in my judgment, unprecedented increase in risk aversion to illiquid long-term assets. And the way we see this is that profit is rising very significantly in the United States, but that cash flow is being increasingly diverted from fixed assets and is going predominantly into liquid assets. The major issue here in this context, which is really quite unusual, is, as I'm sure you know, the United States is undergoing a fairly weak recovery, but profit margins are rising quite significantly, and corporate business is doing exceptionally well. The profits basically are rising not because there's been a great increase in volume. In other words, our nominal GDP is not rising that much. But it's essentially the result of a series of very significant productivity increases. First, there is a fairly remarkable increase in the productivity in the use of energy, materials, and services. On top of that, productivity with respect to labor has, until very recently, also been extraordinarily strong. When you put all of those together, coupled with significant continued increases in foreign affiliate earnings, which incidentally are somewhere between a third and a half of the total earnings of the United States corporate sector, we put that all together, and what you get essentially is a remarkable degree of earnings growth, which is carrying over into the third quarter and presumably the fourth quarter as well. We, of course, are only now just beginning to get the earnings figures for the third quarter, and in general, they're coming in above estimates of security analysts, which is always a good sign in the sense that there is a momentum in the corporate sector. But throughout this year, we have had, as I mentioned before, a dramatic pulling back, fear-based pulling back, and the level of capital expenditures, while rising, is rising far less than the growth in cash flow or corporate earnings. The result of this is a extraordinary change which has put the share of fixed long-term illiquid assets at the lowest level in the United States going back at least 50 or 60 years. That fear or pulling back, or more exactly disengagement from long-term activities, is also reflected in extremely high equity premiums in the financial markets. And indeed, J.P. Morgan's equity premium estimate is the highest, according to them, in 50 years. And the rate of increase in liquid assets as a consequence of this diversion of liquid cash flow into other than fixed assets is causing the record level, or I should say the highest level in the share of liquid assets for American non-financial corporations, the highest level in at least a half a century. This is coupled with a dramatic, probably historic rate of increase in liquid assets. And the question that we have to ask ourselves is, why is it that this particular extraordinary set of events is occurring at this time? That there is this very large pulling back, and I think fairly obviously why it is occurring, meaning that the fear that is arising because it's ever more difficult to figure out what the future is going to look like, coupled with the fact that I would say there are three basic buckets of concern, if I may put it that way. One, of course, is the residual effect from the shock of the financial crisis. That is still, as you point out, still wreaking havoc in the overall system of confidence. Secondly is an unexpectedly large problem with respect to the restructuring of the American financial system. To be very specific, the Federal Reserve Board, for example, which is only part of the banking regulatory system in the United States, has 250 particular rulings to carry through, which, as a consequence of the Dodd-Frank bill, and each one of these takes a goodly time and effort. And so the Federal Reserve is working overtime to convert the Dodd-Frank bill, as far as the Fed is concerned, into specific bank rulings. But at the moment, those rulings are highly indeterminate, and this is feeding the uncertainties which are generating the extraordinary impact in the markets other than direct capital investment. And the result of this is that it's going to take a while. But neither the shock effect of the financial crisis nor regulation is very difficult to pin down with respect to how much impact is that having on capital investment. The third, the very large size of the federal deficit in the United States can be calibrated, and what the data show is over the past 40 years, there's a remarkably high correlation between the amount of deficit as a percent of the GDP and the degree of share of cash flow going into fixed assets. And what this basically means is that there is a significant crowding out that is going on, the result largely of the deficit, the borrowings by the United States Treasury essentially absorbing the savings that are no longer available to the private sector. And this is inducing, for a lot of technical reasons, it accounts for something like a third of the weakness in capital investment, the relative weakness of capital investment. Because remember, it is because the problems here are fixed illiquid assets. One would expect, if fear is what the issue is, you would ordinarily expect that the longer life assets would be under the most extreme suppression. And that's indeed exactly what is happening, because we are getting continued growth, modest, not great, in short-lived equipment and software, with much of the weakness in plant and equipment expenditures in construction. And indeed, construction in both the combination of residential and non-residential in the United States, in real terms, is down over 40% since its peak in 2006. And this has had a major impact on slowing the GDP, because it's these longer-lived assets which, in the typical American recovery out of recession, have led the way. Construction and motor vehicles. Motor vehicles have come back off the lowest levels, but at the current rate of sales, it is still significantly below the level that we experienced prior to the crisis coming on stream. So all in all, what we have at this particular moment is a real structural issue. Now, I'm not going to take too much additional time until we get into specific questions, but I would like to point out a couple of quick issues here, which is where I see a good deal of problems forthcoming and which will prevent us from moving forward at the old pace. Let me just say parenthetically, I think we are probably past the issue where the probability of a double dip is real. What we have is a very sluggish economy. It's one in which is dominated by services which are not cyclically important in the sense that they are major factors in the cycle. And so it's a sluggish, slow-growth economy which has engendered a very high rate of unemployment and a specifically very high rate of unemployment for those who have been unemployed for 6 months or a year or longer. And what that does, as we all know, is induce a significant loss of skills. A disproportionately large amount of this unemployment is from the construction industry, as we are reporting in our specific statistics. But overall, we see little advance in housing for a while, and the reason basically is we still have a significant overhang of unsold inventories for sale. Single-family vacant dwellings for sale. These are putting downward pressure on new construction, and they're putting downward pressure, not significant downward pressure, but some downward pressure on home prices. The figures that came out today show that home prices are somewhat lower, but mainly as a consequence, if not all as a consequence, of sales of distressed merchandise, meaning sales of
repossessed houses.
Homes which have been taken over under failed mortgages by the banking industry and reselling them in the market. Foreclosure sales have been a major factor in suppressing prices in the United States, but the general price level has been generally stable since the beginning of this year. I don't think this is the beginning of a significant downturn. The only data we have on prices currently through September is the median price of existing home sales, which is not a bad proxy for the overall system. That's still stable. But if I am mistaken and prices go down, it's going to create a very harmful situation in the sense that we're dealing with a very large number of homes which have taken mortgages out in recent years and whose down payments have has been essentially down to zero, which means that under this current price level, there is an acceleration of foreclosures that would occur largely because of the fact that in 2005 and 2006, we had 8 million new homes financed in the United States by so-called conventional conforming mortgages, which, as you know, require a 20% or more down payment. And that down payment, as I mentioned just a minute ago, has actually shrunk to a point where if prices go down, the 1/4 of the American householders, homeowners, who have mortgages which are underwater, are going to find themselves joined with a significant part of that 8 million, increasing the stock of homes which are underwater. And as you know, when you get underwater, it's just a matter of time before you start to default. And this is a major problem that hangs over the economy. I would just say, finally, that there is a very serious budget problem in the United States. But I'm not terribly concerned that it in and of itself is going to create immediate inflation. It will eventually. But the reason it is not is that it is very difficult to get inflation in a market economy when financial intermediation is disabled, as indeed our system currently is. But I would not become complacent on this issue. In fact, I think the budget issue is a very critical one in the United States. I think it's being given less concern than it needs to have. And so I should look forward to the fact that when February comes about, which is the next major step where the federal government has to make give some evidence of how it looks at the longer-term budget, there's going to be very major problems in what is cut or what is protected. In other words, what the priorities. All the simple areas of cutting our budget have already been cut. What we're getting at now is entitlements and significant increases in taxes, none of which are good for the American economy. So the great irony at this particular stage, as I said in the very beginning, is the American economy actually seems to be picking up some pace very recently. But in the background are very significant problems overhanging the nature of our recovery. Dr. Chang, let me stop there and respond more to your questions.
Yeah, no, I mean, you are right. I mean, we are going through an extremely uncertain time, and I mean, as you pointed out, the housing situation is on the very, very shaky ground, and budget situation will also need reckoning. I mean, of course, it's easier said than done because, I mean, as you know, I mean, how much to cut, how quickly, I mean, that is the question, really. I mean, no one will dispute that this needs to be dealt with, but if you cut too fast, too much, it will create its own problems. If you cut too slowly, too little, then it will create another set of problems. So I think we are in for a very scary time. But let me move on to the global economy beyond the USA. One of the most important changes in the global economy in the last decade, or perhaps decade and a half, is the rise of China. Of course, we should put it into perspective. I think there's some exaggerated admiration and fear about China. You know, despite just having become the second largest economy in the world, China is still a very poor country with per capita income that is not even 10% that of the United States. And of course, it as a whole is big because its population something like 4 times the United States population, but in terms of per capita income, it's still a very poor country. And I don't think there's any guarantee that this high growth will continue. I mean, there are various structural imbalances and growing inequality means that this could destabilize Chinese politics and thereby disrupt this economic growth in the coming years. I mean, I know that the Chinese government is extremely aware of this situation and is trying to deal with this issue and has indeed invested a lot in the backward regions and so on. But I mean, this will take time to bear fruit, and it's not clear whether it can be done before this inequality becomes a major political problem. But despite these caveats, the rise of China and to a lesser extent India has changed the world power map. So, for example, if the conditions that the international lending institutions and donor governments set for their loans and aids are not satisfactory, poor developing countries can credibly threaten that they are going to go and talk to the Chinese. For another example, as I mentioned earlier, the U.S. Congress has just passed the law imposing trade sanction against China on the ground of deliberate currency manipulation. I mean, I find the logic behind this law highly debatable, and also empirically speaking, the trade surplus by Germany and Japan are actually as big a problem, sometimes even bigger problem than the trade surplus with China. So we need to put this into perspective. But this certainly shows how threatened the United States feels by China. How do you, Dr. Greenspan, see the future prospect of China and its impact on the global economy? Do you think it is good that there is a competition between different systems, or do you think this is a destabilizing factor? How do you assess the future in this regard?
Well, Dr. Chang, I very much agree with what you've just said with respect to China. It seems an anachronism that governance of a country with a Politburo and a state council is nonetheless probably the most capitalist country in the world at the moment. I mean, it is essentially an extraordinarily dynamic system, as you know. But the problem, basically, as you point out, is that there is a very significant problem which governs economic policy in China, which is, of course, to make certain that stability exists at all times. And stability means that jobs get created at a very significant pace, and the very large population that we're talking about means that it's going to continuous pressure on government to keep the unemployment rate low. And that is essentially being done by the fact that a very large part of capital investment in China is a result of initiation by governments, either the local or provincial governments or the federal government, financed essentially by state-owned banks. And so you can create almost as much measured GDP in China as one seeks to do. And indeed, the GDP is in fact accurately measured from the state of input, that is, the amount of raw materials, oil, and people, employment, and the like. And that as a consequence, as far as the rest of the world is concerned, shipping into or dealing with China, it's that GDP level which really matters. Mm-hmm. However, what we do also know is there is an unmeasured degree of misuse of savings in China, in part because of the issue of being more concerned about employment. It's more concerned about producing buildings than in staffing them. And we've all been to Beijing and see innumerable office buildings which are essentially vacant. The problem is that you can do this only so long. And you begin to get, as indeed they are beginning to get, some inflationary pressures, because if the state-owned banks are creating increasing credit to finance a goodly part of this, the money supply begins to rise, and eventually you begin to see the price level rise as well. The Chinese government, quite correctly, is very much concerned about rising prices. And as a consequence, I agree with you that at some point they're going to start to suppress it. Indeed, they've just raised their interest rates by 25 basis points when nobody expected that was going to happen last week, and I think rightfully so. I know the governor of the People's Bank of China very well, and he's an extremely competent individual and knows what's going on in the world. And I'm sure that he is tutoring the State Council on the appropriate policies that must be implemented. Mm-hmm. So I do think we're going to see some slowing eventually in growth in China, but in the near term, it's actually accelerating. And indeed, that acceleration in China in the most recent weeks is creating an increasingly good market for the rest of the world. And so, for the moment at least, it looks as though China is going to be very helpful in carrying the world economy forward.
Yes, I think there are also concerns that, in terms of, as a proportion of GDP, China actually has, over the last 2-3 years, implemented the biggest stimulus package in the world. I mean, some estimates say that it's equivalent to something like 15% of GDP, although I think it's debatable whether it is the right figure. Now, and there are a lot of concerns. I mean, as you pointed out with those examples of empty buildings in Beijing. I mean, they are building the third international airport in Shanghai area. A lot of people question whether they will need it 20 years later, but whether they need it now. And therefore, if any of these go wrong in any major way, I think China's economy could see trouble, which means that the world economy will also be dragged down by. So I think, I completely share your long-term worries about China, but my guess is that the trouble could come earlier than expected.
Well, I must tell you, of course, that events do happen earlier than economists expect. That's the new rule of the economics profession. Mm-hmm. And we have to be careful about it. And I think it's very important to be certain we are monitoring what is going on and to be in consultation with them, as indeed such consultation goes on quite extensively with the Chinese. They're quite open on issues, and my experience over the years, and it's a very long history, visiting Beijing, Shanghai, and other places within China, and meeting with the very competent group of people who are running the government, that they know what is going on, and I'm frankly impressed at how fast they have learned from my initial contacts with them, which were not very impressive.
Yes. Well, that comment on the need for international cooperation and consultation brings me to the issue of the global governance system, if you like. Well, last year we saw the official replacement of G7 by the G20 as the body body for global policy coordination, which gave representation to several developing countries, India, China, Brazil, Argentina, Indonesia, and so on, and if you like, Korea, which is between the two worlds. And this is probably the most significant change in the global governance arrangement since 1944, when the IMF and the World Bank were set up. Of course, being the most significant so far does not necessarily mean that it is significant enough. As we all know, G20 G20 is only a part and not necessarily the most important part of the global economic governance system. In other parts of the system, such as the World Bank, the IMF, and the WTO, the decision-making processes are still dominated by the rich countries more than what are justified by the distribution of economic power. The voting shares in the World Bank and the IMF are essentially allocated according to the distribution of economic power in 1944, except the increased share that Japan has. So there has been a lot of concern, and we are hearing from Gyeongju that where the G20 finance ministers and central bankers met, that Europe has agreed to give up 2 of the seats in the IMF board to make room for developing countries. So things are happening, but probably not enough. People are also concerned, as I am, as I'll discuss in my speech this afternoon, that the stronger and the bigger developing countries in the G20 may not adequately represent the interests of other smaller and weaker developing countries. Literally, 150 plus of them. Of course, some people believe that over time, the very existence of the G20 will affect the way in which other parts of the global governance system are run. In the past, developing country leaders were occasionally invited to the top table, if you like, on ad hoc basis, but this has established them as legitimate participants in the global meetings. So I think we are going to see a lot of interesting changes. What do you see in the future evolution of the global system, Dr. Greenspan? Are we moving towards a more representative and coordinated system of global governance, or is it just another of those kind of talks that look quite promising and then quietly fizzle out after the big events are passed? How do you see this?
Well, let me say that it is true that the G20 is not representative of the total structure of the world economy. But there is a goodly part of discussion that goes on amongst all of the nations at the IMF. Twice a year, everyone meets at the International Monetary Fund, and the discussions that go on actually have representation of virtually every country in Africa and Asia, and not every country, obviously they can't fit around the table is very large, and there are a very large number of people there, but there is a very major input coming from the non-G20 countries as well. I am not convinced that we're going to see very much in the way of significant coordination with respect on the international side. And the reason basically is that domestic political forces still reign in the global world, the global economic world. And when the representatives of any countries either show up at the G7 or previous to that the G5 or now the G20, most of the time and most of the issues are restricted to agreements that had already been made back home in their own countries amongst the various different political pressure groups within the society. And with the exception of certain types of meetings of global leaders, the finance ministers and the central bankers, for example, don't really have very considerable leeway to negotiate. And indeed, I think one can observe last weekend's meeting as representative of that. They did do an important thing, I agree, with respect to the changing structure of the IMF, but there was lots of non-specific, very important issues. In other words, the issue of protectionism and the issue of what happens to economies which breaks the trade, which doesn't allow trade to move forward. I mean, that's all very important to have been said. But there isn't a single country there that I'm aware of sitting around the G20 table who are now going home and going to do something different from what they expected to do before they went to Korea and sat at this extended meeting with a great deal of discussion. And until we see various things happen, like, for example, I think that it's very well and good to talk about the issue of exchange rates. But unless you do something like restricting the amount of accumulation of reserve assets by various countries and or the use of the endeavor to neutralize the effect of buildup in assets on the expansion of the monetary base, you're going to find that the impact of endeavoring to suppress the problems that are existing amongst the currencies and the very important changes that are currently going on, which are creating great difficulties in East Asia, and in one sense, I'm saying that both the United States and China are right about the problems of the other country. What that means essentially is that it's going to be very difficult to get, for example, a sustaining, holding down, a contraction of the amount of purchases of assets to sustain currencies, or their sterilization once the reserves move into the central bank. And unless we get specific in those respects, it's not going to mean very much to say we would like to see countries who are surpluses reduce them and the countries that have deficits reduce them. Remember that surpluses and deficits are determined by the net effect within the economy, savings, investment structure, and it is a very complex calculation that ultimately determines what a current account deficit or a surplus is. Merely to specify we're going to change it and come to grips with how complex that problem is. And the only thing that I can see that we can do which would have some significant impact is the issue of restraining accumulation and sterilization. Once assets are accumulated, that will have some effect on exchange rates and, as a consequence, will create global current account imbalances, which essentially reflect the true imbalances that are involved in certain countries, which can have prolonged deficits or prolonged surpluses for long periods of time, basically because of their structure. But those are sustainable. And the major problem that we have is the unsustainability of a goodly part of the imbalances that we now confront.
Yeah, I think I could kind of add to your remark that, even within the same country, different people have differing interests. So, for example, in the United States, the financial industry tend to support the strong dollar policy. Manufacturers want weaker dollar. I mean, at the moment, the U.S. government is engaged in quantitative easing of unprecedented scale, and that naturally has a downward effect on the currency. And I mean, all these complex things are going on. So I absolutely agree with you that, I mean, the president or the finance minister could say that we want to do this, but can you really reconcile domestic politics with those? I think those are very astute observations. Now, shall we talk about this issue of regulatory reform, especially of the financial sector? Well, Dr. Greenspan, given the prominent position you had occupied in the years before 2008 financial crisis, you have had to take on unfair share of criticisms for the crisis. Well, I guess it's occupational hazard, but many people have blamed you for keeping interest rate low, but I side with you on that issue. I don't think low interest rate per se was responsible for the financial bubbles. But you probably agree to an extent, and I strongly believe that low interest rate policy should have been accompanied by appropriate regulations to prevent asset bubbles from developing. For example, the tightening of mortgage lending regulations. For example, in the UK, that in 2004, 5, 6, you could sometimes borrow money, not just with no down payment, but could borrow actually more than the house was worth. So that kind of regulation was absent. Or in the stock market, there could have been raising of margin requirements. I mean, there were various measures to restrain this bubble developing. Unfortunately, this did not happen. And also Mr. Paulson, when he was in the Treasury, actually eased the leverage regulation for financial firms, which they encouraged these firms to expand at a very rapid rate. And also, I think there was a lack of regulation on financial derivative instruments like CDOs and CDSs and so on. And all this, I think, increased the size of the bubble in the first place and hugely magnified this impact on the impact of its collapse. I think especially the explosion of financial derivatives has turned the bursting of what was a very large but by no means unprecedented housing bubble into the second biggest financial disaster in the history of capitalism. I mean, that some guy failing to repay his mortgage in Louisiana had impacts in Germany and Japan and Switzerland and so on. So I think this has made the problem extremely difficult, especially in the early days of the crisis. People didn't even know which assets were where and how much they were worth. They were hugely increasing the uncertainty, and I think the uncertainty that we are still experiencing, as you mentioned earlier, also has to do with this aspect. What is your view on the role of financial deregulation in the making of the 2008 crisis? I mean, could we have done more and made this less disastrous, or do you think it was just unavoidable? What would you say?
I think it's important to diagnose what the nature of the problem was, because if we misdiagnose it, the basic changes that we're going to make to address the problem won't work. I think the fundamental problem really got down to the issue of evaluating risk in the most general sense. If we had adequate capital in all of our financial institutions, by definition, there would not have been a crisis, because the losses would have occurred. But if capital was adequate, they would have been absorbed basically by shareholders, and senior debt holders or even junior debt holders would not have run into trouble. In other words, you would not have had the debt default problems which creates the contagion. Because while you do get an impact because of the wealth effect of asset prices coming down and having an economic impact, it doesn't spill over to rupture the financial system. And I would go a step further. I think this financial crisis that we had was the greatest in history. I grant you that the Great Depression was by far a more major economic problem.
Yeah.
But I don't recall a global system in which short-term credit instruments literally were withdrawn from the market. In the United States, as you know, we did not have any shutdown of markets during the Great Depression. The call money rate, which was the quintessential short-term money market in the United States at the time, went to 20%, but it didn't shut down. In 1907, the call money market shut down for one day. But in our most recent period, we saw the commercial paper market shut down effectively. We saw money market mutual funds within hours of the bankruptcy of Lehman Brothers in trouble. And the Federal Reserve very rightly had to substitute sovereign credit for private credit to maintain the degree of intermediation required for a market economy to function. So this was really the most extraordinary set of events. Had we known what we now know, namely that the negative tail of the risk distribution in general, as economists like to say, was much fatter than anybody realized. And the result of that is we had inadequate capital in financial institutions, which were especially the case in Lehman Brothers and Bear Stearns. And I would argue that if both Bear Stearns and Lehman Brothers, instead of having 3% tangible capital at the point of crisis, had 15, still be around. And indeed, if everybody had adequate capital, there would not have been the crisis in the financial system. There would have been a repercussion from the collapse in the bubbles. All bubbles, by definition, collapse. But not all bubbles have secondary negative consequences. The dot-com bubble collapsed, and its repercussions in the financial system were wholly absorbed within the equity parts of the markets. We did not have significant debt contagion defaults. The housing market was something else again. And I won't get into the details of what the Federal Reserve did or didn't do, but the interesting problem about that whole particular period is that it was long-term interest rates which came down as a consequence, as I pointed out in a book I wrote 3 years ago and a Brookings paper, which I did very recently, was the long-term interest rates in the world came down largely because of the huge acceleration in economic activity in the developing world amongst economies which didn't have the infrastructure to spend a goodly part of it. So we had this huge amount of savings spilling over into the global markets, inducing a major expansion in the bond market. Indeed, prices moved to such a point that by 2006, every developed country and most of the significant developing countries all had single-digit long-term interest rates for the first time ever. The problem was not in the United States the result of overnight interest rates. Overnight interest rates are not employed to capitalize assets which have a long life, such as a home. And in my judgment, when you look at the data, there's no doubt that we moved the short-term rates down, and we did for very good reasons, which I think was the right move even today, because we were confronting concerns about a rapidly declining rate of inflation with the same sort of problems which we're now confronting. But the main issue is that mortgage rates, the 30-year mortgage rate, which is correlated with the price levels of homes, did not go down significantly. And indeed, money supply didn't expand in any material way. So I think the reasons why we had the problems we had very little to do with monetary policy. In fact, most anywhere that I can conceive, because with a globalized international bond market, you cannot have bond prices determined both by the central bank and the international market. And what happened was that we at the United States found ourselves losing control of the 10-year Treasury notes yield. And that was true generally pretty much around the world. So we have to recognize that the problem here was basically the issue that there was not enough capital in the system, and that where the major changes have to occur is in raising capital requirements. There are two issues here with respect to other than capital requirements, but they basically relate to the issue in the United States, where I don't believe we actually addressed fraud adequately. There was a lack of various actions against fraudulent activities, and indeed we have to enhance our ability to counter fraud, because in all of the areas where we had problems in, for example, the subprime mortgage market, it was fraudulent. And the fraudulent actions are illegal, and they are detrimental to the effective working of a market. A free market cannot exist if there's extended fraud involved in the trust, in the transactions which go on, because trust in a market is a critical ingredient to its functioning. So I think that we don't need to do a great number of things. I think the things that Basel III is doing is in the right direction. I happen to think they probably have got the numbers right. We did have a measure of what the markets were saying about the need for additional capital after the Lehman crisis. And if you look at the behavior of credit default swaps at the time, when the very necessary infusion from the Treasury of bank capital in the United States had very major impact on the price the day that the announcement was made by Secretary Paulson. The price of credit default swaps collapsed. If you looked at that event, you would infer that we were probably short somewhere between 3 and 4 percentage points of capital in the major U.S. banks, and I think by extension, pretty much elsewhere. And that's largely what I read in the structure of what the Basel III agreement is. There are serious questions about whether the risk-adjusted assets are being properly evaluated, and you can't discuss capital without discussing what assets are you referring to and how you basically mark them down. But I should think that we can essentially protect ourselves against similar events, because as you imply, I'm not sure once a bubble begins that it can be prevented from running its course. And it's hard to know what caused the double bubbles that occurred, but clearly a major factor was the euphoria that was engendered by the fact that we had a very protracted period of world economic expansion with very little in the way of pause. Great Britain went through an extraordinary period without any recessions. Our recessions in the United States were the smallest in the post-war years, and it's understandable that rational people, when confronted with a period of continued extensive expansion, would begin to lower the cost of capital, and that's where our problem was. But had we enough capital in the system we would have taken the losses, because there was no way, as far as I could see, where we could have stopped the dot-com boom. In fact, the Federal Reserve tried to do precisely that and failed. Indeed, if anything, we made the situation worse by our trying to raise interest rates to hold what we called inflationary pressures, but which the markets could very readily have read as essentially irrational exuberance. And the result of that is that the dot-com boom ran its life. It crashed. It created significant wealth losses. It created significant impacts on capital investment and the various aspects of the real economy, but did not create the type of problem that the second bubble did. And the second bubble did because it was cumulative over 15, 20 years, and the result of that is that it could only have been contained if we had the type of capital which meant that all of the losses, and they were going to be very large, including in CDOs and CDO squares and all of the innovations of finance which led it to significant problems, those would have had effects on shareholders of financial institutions and would have not have had the contagion effect. And so I think it's very important for us not to spend too much time dealing with details which are really unnecessary if there's adequate capital. And I am frankly fearful that the very type of restructuring we're trying to make of the financial system is itself creating negative effects, specifically on the reflection, going back to the very early thing I said early on in our discussion, which is the extraordinary risk aversion to illiquid assets. And I think that we've got to calm the system down, let the economies heal. And I think they are showing signs of that. But continuously inducing stimuluses which don't really have the effect that a lot of people are saying. In other words, I think that stimuluses did increase economic activity, the last one, but nowhere near that the econometric model-based estimates indicated.
No, I think you are absolutely right in saying that one main way to deal with this should be increasing capital requirement. We'll go back to that issue a bit later. But I think there's a problem in arguing that we were caught by this unexpectedly fat tail end of the risk distribution, because in many ways the various deregulatory measures made actually the tail fatter. So I mean, it's not an independent event. I think some of these deregulatory measures actually increase the risk, and therefore it's not an independent event. I mean, we cannot quite say that the tail was there independent of our action and that we were caught by it, because what we did actually made the tail fatter. So I think there is a correlation between, at least, if not necessarily causality, between these two things, and we can't just say that we are just caught unawares. I mean, of course, there were also issues of fraud, but why this fraud became so easy to make. It wasn't just this semi-educated people that were caught by this. I mean, when you see the list of people who are defrauded by Bernie Madoff, I mean, it beggars belief. I mean, all the major banks in the world, HSBC, Santander, I mean, major universities with that world famous economics and business faculties like NYU, I mean, these people all caught, and the reason is because we have made things too complicated. No one really understood. Okay, I mean, people understood bits that they were dealing with on daily basis, but a lot of confessions have come out after the event by the top bankers and so on, that they essentially didn't understand what was going on. So I think this the process of deregulation created complexity that we cannot really deal with, and that's what in many ways made the tail fatter. So I think while I agree with your argument that a lot of these problems actually can be and should be solved by increasing capital requirement, I think we also need to think about this issue of deregulation in a more kind of coordinated way.
I actually don't disagree with you on that. The issue is basically the question of when you have innovation expanding, and I don't think it's the result of deregulation. I think it is the result essentially of the dramatic rise in innovation within the financial system. But by its very nature, a goodly part of innovative products fail. And if you have an extended expansion of innovation in finance, it necessarily follows that you're going to have more failures. What was missing at that point is, in part, the recognition of the tail risk, which is exactly as you point out, except that what we missed was that as the innovation expanded and the advantages of innovation, I mean, I happen to think that a goodly part of the innovation was actually very helpful. I think that the securitization, the expansion of derivatives was actually a positive, not a negative. But what we failed to do was to recognize that in all innovations, you're going to have a significant proportion of failures. That's in the nature of innovation, not only in finance, but in Thomas Alva Edison failed more times than anyone can imagine before he finally succeeded in doing something. So what you need to do is, when you have expansion of innovation, which was not the result of deregulation, the deregulation was already there. It's the application of moving into ever new innovation which failed to be compensated for with higher capital. So it's not that I disagree with the conclusion you're having. I just would say I would focus on the issue not in terms of deregulation per se, but adequate capital for the expansion that exists under a deregulated society. We had a goodly part of the capability of doing much of what was done in recent years, years before it all began. The interest and the euphoria, however, did not exist, and that the willingness to take risks that a lot of the financial institutions engaged in was not there. It's only as the markets began to get ever more euphoric that new types of risk-taking was taking place. I mean, you would never have synthetic CDOs. You would never have some of the extraordinary types of mortgage lending, which you point out in the UK, but also was going on in the United States, where effectively lenders, so anxious to get an increasing share of markets, were offering debt at more than the price of the homes, in the expectation that the market price would continue to rise and actually cover the requirements for debt repayment.
No, I agree with you that
what was wrong with the system. I should say that's the way the system was functioning. What should have been done
Its compensation for that is in the capital account. There is where the problem was. And I think all of these issues can be addressed with the issue of enforcement of fraud and the issue of capital, because all of the other aspects of that we're now endeavoring to correct would be fully corrected if both of those aspects of our regulatory system were appropriately in place. Mm-hmm. Now, I may be wrong in reading that the CDS market was telling us that 4 percentage points was enough. But something is enough. I don't know what the actual number is. Mm-hmm, mm-hmm. And if we have enough capital, by definition, you cannot have a financial crisis.
Yes, I mean, I think if I may bring in an analogy, you are essentially saying that faster cars need better brakes. So, I mean, if you have all this innovation generated in a deregulated system, you probably need better brakes in the form of a stronger capital base. But I think, I wouldn't go as far as your predecessor at the Fed, Mr. Paul Volcker, who once quipped that the only useful financial innovation that we had in the last few decades was the automatic teller machine. But I have a disagreement on how useful these innovations were, because, the world economy grew at something like 3% in per capita terms in the 1960s and 70s, when we didn't have all these financial innovations. In the last 3 decades, the growth rate, despite the explosive growth in China and so on, the world economy grew at barely half that rate. So were they really adding much value to the economy? I mean, my view is that, yes, I mean, they probably did some useful things, but the side effects are probably overwhelmed by the positive effect, in the sense that the creation of all these new and complex instruments has enormously led to the complexity of the system. I mean, you very much correctly pointed out that the system is now too complex for any detailed regulation to work, and therefore we need to have a more general system of dealing with it through better capital requirement. But can we kind of do some lateral thinking and say that, well, if this increased complexity is a problem, why don't we simplify the system by allowing some of these very complex instruments only when the creators can positively demonstrate their net positive effect? I mean, in the same way that drugs need to be approved by the government, for example, by the FDA in the United States, before they could be sold. I mean, as you, say in your Brookings Papers article, actually some of these the financial innovations were downright unproductive. And I mean, I agree with you that it's in the very nature of innovation that we cannot predict exactly which one will do better and which one will create problems. But I don't think it is totally impossible to predict the future. I mean, some of these products were so downright complex and problematic, we could have prevented some of these. I mean, I respect your view that, in a way, our ability to make good decisions is the scarce resource, but we shouldn't go then too far and say that, well, you never know, so we should let 100 flowers bloom and see what comes out, because they, by making the system complex, overwhelm our ability to deal with it. I mean, if that wasn't the case, why would all these the PhDs from top universities running these investment banks have failed so dramatically? I mean, it wasn't they were kind of incompetent in the technical things they were doing, but they got just overwhelmed by the complexity of the system in the development of which their innovative products played a role.
Well, there's a specific issue out there which I don't say I know the answer to. There's an important fact, and the fact is that around the world, the share of national income originating in many, if not most, of the major economies that goes to finance and insurance has been rising for decades. In the United States, finance took 2.3% of national income in 1947, and by 2009, it was up close to 8%. Now, what is remarkable about that is the share of finance relative financial income originating in the society in 2009 was higher than it was in 2008 and 2007. And not only is the rising share evident in, say, the United States, it's also in a number of other countries, including China, which shows a very significant rise in the share. Now, remember, taking the United States, by the way we keep our accounts, these are consolidated shares of income, which means that all of the income originating in finance must come either from the non-financial sector of the United States or abroad. Now, the data show that amount of purchases of financial services on a foreign account in the United States is relatively small, and almost all of the increase in the demand for financial services is coming from the non-financial area, or as we like to say in the United States, from Main Street, not Wall Street. The financial system cannot, by itself, engender any net national income. The question I raise, therefore, is: what is causing this phenomenon? Is it possible, and I don't know the answer to this question, that the extended continuous division of labor, which is an essential part of the growth in standards of living throughout the world, has been requiring an ever-increasing share of financial services? And this would be wholly consistent with the view that we had a viable economy 50 years ago with far less financial intermediation, but the level of standard of living was very significantly lower than it is today. And I've been struggling to find out why this phenomenon exists, why it's a global issue and not specific to the United States. And what it basically is saying is that the marginal increase in national income that's been going to finance in the United States is about 10%. And we can curtail that very significantly. But can we do that and still maintain the existing level of division of labor in the global markets and the levels of the standard of living that accrue as a consequence of the division of labor that is reflected in productivity or output per hour, and therefore in real standards of living?
Yes.
I don't know the answer to that question, but I do know that the answer is not necessarily one way or the other.
No. Yeah, no.
I'm merely saying that we had a less complex world 50 years ago is accurate. It is also accurate that the financial system was in the United States, far simpler than it is today. And unless I can feel comfortable answering the question that curtailing the size of complexity, not necessarily that exists today, but that is capable in this degree of open markets and international trade, I feel very uncomfortable about constraining the financial system because it is the non-financial area of our society which is requesting the services, requesting the various different types of risk amelioration, which the financial services essentially do. That's what they do.
Yeah. No, I mean,
I'm
despite
puzzled by all of this. And I do admit, as I said in many places, as you quote, that the issue is too complex for us. We are having great difficulty in handling it. But we have to be careful in addressing that particular subject, which I agree with you on, is really quite significant,
of course, yeah,
without undermining the ability for our financial systems to supply what the non-financial sectors of our economies are requiring to maintain the degree of productivity.
Yes, I mean, please don't get me wrong. I mean, despite my criticisms of certain aspects of modern finance, I strongly believe that finance is really the key element in the development of capitalism. In the 18th century, people like Thomas Jefferson, the objective even to have having banks. I mean, I think that kind of mentality is wrong. However, I think it's also true that we have seen the explosion in the financial industry, some of which may not be justified. Back in 1970, total world's financial assets was something like 1.2 times of world GDP. Of course, these two figures are not strictly comparable. I'm just putting it that way to put it into perspective. Today, the ratio is 4.4. So compared to, say, 40 years ago, we need nearly 4 times more financial intermediation to create the same output. Now, I mean, that some of it is definitely due to increasing the complex nature of division of labor. I think we really need to look harder to see what are really the necessary element and what are finance that may not be socially productive. I mean, we can, of course, conclude the debate on that here, but I think probably the first place to start is to say that anything that makes risk assessment more difficult should be seen with skepticism. I mean, we've seen all these rating agencies failing to correctly rate assets. I mean, which is obviously not because they were incompetent in the simple sense, but instruments have become too complex. When you bundle thousands of mortgages from another country, it's very difficult to really assess the risk. So I think, while generally agreeing with you that the solution should be simple kind of curtailment of the financial sector, I think we need to look a bit harder to see what is making our system overly complex and overwhelming our ability to deal with it, both at the individual firm level and at the systemic level.
Well, I certainly agree with that, and I think that we're going to find that as the years go on, an ever-increasing share of PhDs in economics and finance is going to be discussing this particular subject. And I don't think one can argue that there is a loss. In other words, it is certainly the case that we need an ever-increasing degree of intermediation to create the level of output. But that is part of the overall process by which standards of living have been rising. That is, we have the amount of physical facilities, capital facilities, are rising faster than the labor force.
and we're finding many parts of the difference between balance sheets and income statements moving differently. And I think the reason for that is that as we get ever higher in levels of living, the nature of the supports of the system are changing. As you point out, I'm so much surprised at your knowledge on this issue, that Thomas Jefferson was not in favor of banking, and the opposition to the first bank of the United States was very extraordinary in this country, United States.
That's right. Yeah.
And the basic issue is finance has grown from a negligible part of our economic system, but has risen as standards of living have grown irreversibly higher. And what I don't know is whether, in fact, at the level of standards of living currently experienced now around the globe, we need greater degrees of financial intermediation to make it work. And that's the question which, as I say, I think a lot of theses are going to look into, because that is going to be one of the fallouts from this particular crisis, in my judgment.
Yeah. No, I agree with you. I mean, we want faster cars. I mean, we don't want to ride in bullock carts. But faster cars probably means better brakes, better traffic rules, better roads. So let's think in those terms. I mean, rather than trying to say, well, that there were fewer casualties on the road when we were driving bullock carts. Yeah? But, I think that until recently we thought, cars get faster and that's enough. Yeah? We need better infrastructure. I think our time is up. Dr. Greenspan, thank you very much for staying until late hours to talk to the audience here. We very much appreciated you sharing your distinguished experience and wisdom. And I hope that we keep debating these issues in different forums, and we all strive to build a better, safer world. Thank you very much.
Well, I must say that we've had a debate, I guess, in one form or another, and I just want to say I very much appreciated being invited and to participate in the Global HR Forum. I think it was a very interesting set of discussions, and I compliment you, Dr. Chang, on having considerable insights into many of the global issues which we're all dealing with, and hopefully the process will be productive, that we'll all learn more. Thank you and good night.
Thank you very much.